But what I'm going to talk about today is I'm going to focus on kind of post-harvest corn and soybean outlook, give some estimates of where we see prices going in the current environment, talk a little bit about some of the key factors that's going on right now. But before I jump into kind of the corn supply and demand and soybean supply and demand data, I do want to talk real quickly about exchange rates and then export sales data. So when we look at the value of the US dollar, this is the US dollar index since about the middle of March has been in a pretty steady decline. We've seen it go down about 11.2%. You know, that's a comparison of the US dollar against a bundle of other currencies. And so there's some currencies in there that are obviously more important than others in terms of agricultural trade. So I did kind of want to single out two, because even though we do have this steep decline, you know, it does really matter more when we look at individual currencies, what the impacts potentially are in terms of exports and trade in general. So the first one I want to kind of just highlight is the Brazilian real. What we have seen is over the course of 2020, we've seen a tremendous devaluation of the Brazilian real. That obviously has dramatic impacts on soybeans. We've seen it kind of stable since about mid-April, where we've seen it move sideways. So back on January 3rd, one Brazilian real was equal to 24 or 0.248 US dollars. So again, we kind of translate that into soybeans. What we're looking at is $9 US soybeans was returning about 36.29 Brazilian real. You go to August 18th, and that same one Brazilian real was now worth 0.182. So again, you see that translation into Brazilian real in terms of the value of soybeans, and that 26.6% drop really was beneficial to Brazilian farmers in terms of exporting their product, particularly to places like China. Now, again, they're going to get caught on the back end of that with a weaker currency. It's much more difficult to bring in agriculture inputs. So again, it is kind of a trade-off, but there is a lot of movement in these currency exchange rates. We look over the same time, again, we're comparing the Chinese yuan right now to the US dollar. And so again, what we've seen is over the same period of time, yes, there's been some fluctuations, and we've seen some recent strengthening in the Chinese currency, which has helped with export sales. But what we've seen is it pretty consistent in terms of what range of value we've looked at in terms of the US dollar versus the Chinese yuan. One other one I just wanted to quickly touch on was there's been a lot of I guess, news or in agriculture news about some of the export sales data. And so I did want to kind of break this down in weekly, both for corn and soybeans. This is export sales to China from January through August. We're showing three different data sets here. So accumulated corn exports, the blue dotted line is the amount that's actually been shipped. Outstanding sales, there's two different marketing years. There's the current marketing year, which ends at the end of August, which is the orange line. And then there's next marketing year. What you can see is we've seen a tremendous ramp up in Chinese purchases of corn since about the beginning of July. So we're up to about 5.72 metric tons. 1 metric ton is 39.368 bushels. So again, this is a positive note, because China typically hasn't imported a ton of US corn, but what we've seen is these new crop sales have really accelerated in the recent months. Now, whether this continues or not, we'll have to wait and see what happens from a political standpoint, but it does appear that there is some additional ag purchases that are occurring in terms of Chinese purchases of US agricultural products. Have the same graph for soybeans. Soybeans obviously much more a much more vibrant history of sending it to China. And again, you see those accumulated export sales up around 14.15 million metric tons, so just over 500 million bushels that we've sent so far in this marketing year. Plus, we have some remaining outstanding sales of 2.7 million metric tons. But again, what we've seen is a ramp up for the 2021 marketing year of purchases of soybeans in China. So again, part of this is obviously tied to potentially them trying to get closer to achieving the phase one trade commitments that they've had. But it is a positive right now in terms of having these additional sales So when we look kind of just, I want to quickly go through just supply and demand before we get into prices. There was some additional yield information that was released last week. Right now, the USDA has national yield at about 181.8 bushels per acre, Tennessee at 178 bushels per acre. That doesn't account for that Direcco that ended up going through parts of Iowa, Nebraska, Illinois, and Wisconsin. And so some of the estimates are still a little fuzzy as to what the direct impact's going to be, or the reduction in production is going to end up being. We'll have to see, how much of that production is actually affected. I'm sure there's going to be some where there's going to be moderate yield losses, and then there's going to be others that are going to be pretty much a complete wipeout, or it'll be turned into silage. It's going to be tricky for harvesting up there. So again, we'll have to see how that plays out. But if you do look at where we are in terms of where our ending stocks are projected at, even if you take that 200 to 500 million bushels off, we're still going to be somewhere close to, just over 2 billion bushels in reserves, given the current USDA estimate. So again, we do still have a tremendous crop potentially coming in. And so we'll probably likely get to see substantial carryover that's going to kind of keep a lid on some prices unless we see a real disturbance someplace else. When we look at 2021, ethanol's bounced back pretty good. It's not all the way back, but that was the one that really took the brunt of the COVID-19 impact in corn. When we've seen tremendous declines in corn use for ethanol, we will end up seeing how that continues as we move into 2021. There's a lot right now with the RFS, some of the small refinery waivers. I think that will be a political issue, particularly in places like Iowa. And so we'll have to see how that ends up going between now and election day. The exports I mentioned, it's in a good set of circumstances right now, but we'll have to wait and see how that continues to progress. When we look at world corn production, consumption, ending stocks, there's a little bit of good news. We've started moving more sideways in terms of ending stocks. So when we factor in that if you're moving sideways and you're increasing consumption over time, you are reducing that stocks to use ratio or days on hand, the reserve amount that the world has for corn. There's still an abundance of corn out there, but again, at least we've come off the recent highs. One of the challenges that is still out there is when you look at production ramping up in other parts of the world, where you see from 2013 to 2020, Brazil's up 34%, Argentina's up 92%, and Ukraine's up 28%. And that obviously competes with exports as they send a good chunk of that production out to global markets. So when we look at December corn futures, one of the real challenges of this year is obviously we've seen the tremendous decline triggered by the COVID-19 pandemic when we had the issues with refineries and shutdowns. And then we've kind of moved sideways. And we had two kind of rallies or moderate rallies in corn futures. The first one was that June 30th acreage report where they did reduce the amount of acres. We got about a 25-30 cent rally. And then we had the Direcco at last week that ended up triggering another rally. But what you can see is from pretty much the end of March all the way through August, we really haven't seen a great opportunity in terms of pricing. 365 is not going to get a lot of people overly excited about pricing corn. So one of the challenges I think we're going to have this fall is that I think we're going to end up seeing that there's a lot of unpriced production out there. And that could end up being a tremendous disadvantage, particularly for those that don't have any storage. So when we look at Tennessee new crop cash corn contracts, again, this is for harvest delivery. We see that same phenomenon where we're looking, somewhere between, $3 up to about $3.65 at elevators and barge points. Obviously, if you're delivering to poultry facilities or other feed companies, you can probably get a little bit more of a beneficial basis. But we have ended up seeing these cash prices kind of move pretty much sideways since we've bottomed out. We'll see how long this little rally here lasts in the next few days. It's really going to be determined by how big the loss estimates are coming out of the Western Corn Belt in terms of the storm damage. One thing that I do want to quickly just point out is we've had actually pretty strong basis relative to where we have been. When we look at 2020 versus the 5-year average, You know, we've been right around, you know, 13 to 17 cents, 9 cents above, over the board. So again, this is a little bit stronger than normal. See how that ends up going into the fall. But again, what we're looking at in terms of a marketing standpoint is trying to avoid marketing corn during this period when we end up having significantly weaker basis. So again, when you look at the difference on average, and again, you have to be careful with averages because each year is a little bit different. But if you look at, say, from September through to February, you're looking at almost a 30-cent difference in terms of basis. And so you really have to ask yourself, what's your cost of storage, and does it make sense if you do have storage? You know, it definitely extends the marketing window, allows you to end up being able to participate in post-harvest rallies. So again, looking at some of these options, there are methods in the futures and options market for re-ownership if people are interested in that or don't have on-farm storage. But again, having that storage, I think, is one of the most powerful marketing tools we can have in Tennessee for corn, just because of our strong basis and our strong demand base for livestock, poultry, and ethanol. So one thing I do kind of want to just kind of look and see where we're at. I know everybody's cost of production is going to be slightly different, in some cases extremely different. What I did, I just kind of ran an estimated profitability right now at $650 per acre cost of production. You know, that's going to vary tremendously by operation and what you're targeting in terms of yield. But at $650, if you're looking at yields between 160 and 190 and prices between $3 and $4, you know, there's a lot of red ink still in there. So again, either having lower cost of production or higher yield is going to push you into potentially a profitable situation. But we're still looking at having needing very strong yields to get into some black ink. We can even find that, because as of right now, if you're looking at 350, even at 180, you're looking at a $20 per acre loss. So again, any way that we can end up getting a bit of a price premium, you know, yields are pretty much going to be set to some degree now. You're not going to end up seeing tremendous variation. So you should have a pretty good understanding of where each individual farm sits in terms of yield. It's obviously the vignettes, there still is variability. But again, running some of these numbers before we enter the harvest season is probably a pretty good idea, just to see where some of the numbers are relative to cost of production versus price and yield. One thing I think is important to consider in this environment is we always are concerned about the price that we're potentially getting, but what we really want to look at is profit, right? If we see some opportunities when we get a combination of yield program, that only really affects the old crop. So the 2019 crop that was held in storage, will there be some additional money that comes? I think there probably will, but right now we just don't have the details on that. So what we do have is kind of our traditional farm safety net ARC and PLC that was authorized in the Farm Bill. And if you're looking at corn 2019, probably not going to see a ton of high payments for that program. Right now, with a 10-cent payment rate, you know, if you have 150 bushel per acre PLC payment rate, you're looking at a payment of about $13 per base acre. And these are the ones that will be received in October 2020. So again, how you want to end up analyzing that in terms of farm financial analysis is a little bit tricky in my mind, because it's going to be the 2019 crop, but the payment received in 2020. And so when you switch to looking at 2020, and again, there's a lot of time between now and the end of the marketing rate, we are, under the current environment, looking at somewhere around that $76 per base acre. Now, one thing that we're kind of, it can be a blessing or a curse in Tennessee, is these are paid on base acres, not on planted acres. And so again, if your FSA farms have different base than what you're planting, you know, it's a little bit more tricky to kind of conceptualize how that translates into an individual crop. Switch over to soybeans right now. One thing I should mention, you know, when we're looking at new crop right now, we're looking somewhere between 310 and 370 as we move into the harvest time period. Again, a lot of that's going to be dictated by how harvest ends up progressing and what that ultimate damage was for the storm systems that moved in through the Midwest. When we look at soybeans again, we're looking at almost a 50-50 split between exports and crush. Soybeans will not have the same losses as corn from the recent derecho. You know, I'm sure there will be some damage, but I don't think it's going to be the widespread issues that we'll see in corn. When we look at the national average yield, USDA's got it at 53.3. Again, that doesn't account for any potential damage or any issues that continue to end up emerging as we go through the rest of the production year. Tennessee's average yield at 49 bushels per acre. So again, we're looking at a pretty good state average. Exports will be the big wild card in my mind. When you look at where USDA has it projected right now, 2.13 billion bushels. Obviously, if China really ramped up purchases to try to meet the phase one trade deal, I think we would end up seeing soybeans playing a very large role in that. So again, what that does is kind of expands what our reasonable price expectations are. It adds a greater degree of uncertainty just because we don't really know, you know, there's a lot of unpredictability between the relationship between the US and China right now. And you could make a pretty reasonable case for increased purchases or having, you know, a pullback by the Chinese once the South American production comes online or has a better idea of what it's going to end up being. When we look at world soybean stocks, again, we've seen it kind of drift lower for 2 years in a row. Again, we're not short of soybeans by any stretch of the imagination, so that is going to continue to keep a lid on prices. So dramatic price spike without something substantial down in South America remains reasonably unlikely. You know, the exchange rates do play a very important role when you're looking at where export business is being sourced. So does trade policy. So again, you know, there's a lot of moving parts when we're looking at where these soybeans are going. And again, if we're looking at roughly 50% of the crop being exported, you know, these are very important in terms of where prices are going to end up going. Right now, there's a lot of estimates out there that Brazil will have record planted acres this fall. So again, we'll have to wait and see how that ends up occurring. They'll start planting their soybeans after they finish their harvest of the second crop corn. So again, this is something that is going to be very important, is going to be a big price mover once we end up getting through the U.S. harvest. When we look at November soybeans, what we have seen is we have seen a kind of an upward trading channel in terms of prices where we bottomed out back in April. And what we've seen is yes, you know, some volatility for sure as we've seen movements due to COVID-19 and also trade news. But what we've seen is a pretty consistent upward trade channel over time. Again, prices probably aren't where a lot of producers want them. In terms of futures prices, 920 down to about, you know, 860 is kind of where we've been seeing this, but the price trend has been positive. When we look at Tennessee new crop cash contracts from January through August at elevators and barge points, what we've seen was that rapid decline, and then what we've seen is a mild recovery, but it's going slower than a lot of us would like. But again, we're getting close to that 950 range, which I think is a good time to start thinking about at least some initial sales, particularly since we didn't have a strong opportunity to market a lot of this crop during the growing season. It might be worthwhile to end up considering at least some moderate sales when we get close to that 950 range. Another one similar to corn, we have had a very strong basis. Whether this can hold through harvest, we'll have to wait and see. But again, what we've seen is typically in Tennessee on average over the last 5 years, we've had a negative basis. But over 2020, we've actually still been able to maintain a positive basis. Now, obviously, it doesn't offset the declines in the futures market. But, you know, anytime we can end up getting a stronger basis, it does affect how we're going to be able to market our crop. Looking at that profitability outlook again, there's a tremendous amount of variation in cost of production for soybeans. A lot of it is going to be dictated by, you know, if you're having issues with weed control, and then ultimately one of the big ones too is going to be your land costs, right? There's tremendous variation across the state. You know, there's places where they're paying $200, $250 per acre. So again, if you factor that into your cost of production, you know, it's going to be a wider range for a lot of people. Some people are going to be a much lower cost of production producer. But again, when we look at kind of that 850 to 950 range. Even at 45 to 60 bushels per acre, there's still a fair amount of red ink in there. So again, having an understanding going into the harvest where your yield expectations are and where your cost of production will let you know kind of what price you're looking at in terms of being able to cover your costs and hopefully get into some black ink. So when we look at soybean outlook, wider variation in prices, you know, 860 to 975, a lot of that just because of the trade uncertainty. It's a challenging thing to predict in terms of what China's going to end up doing in terms of their purchases. When we look at government payments, unfortunately for soybeans, the existing PLC and ARC payments are pretty abysmal and haven't materialized. In terms of PLC, ARC, there could be some, but that's going to be a wide variation from a county to county. A lot of it depends on where that guarantee is in terms of the county level. So again, there will be some counties that will get, you know, close to $25 per base acre on soybeans. There'll be a whole bunch that get zero as well. And so when we look at 2020, there is a small payment for PLC. This will be the first PLC payment that we'd ever get under for soybean base acres. But again, we still have over a year in the marketing year to see where that ultimate price is going to end up being. But again, in terms of your PLC and ARC payments, corn, you probably got a substantially greater likelihood of getting a payment and having a higher payment than soybeans. When we look at CFAP 2.0 or MFP 3.0, we'll have to wait and see if there are details. Like I said, I am sure that there will be something, but again, we just don't have the details on how that's gonna end up playing out. So I just kind of want to wrap up with just kind of some general marketing considerations. I've kind of touched on some of these, but just kind of want to bring this to kind of a conclusion. When you look at what you're looking as you enter in the harvest season, you need to have a good understanding of what your investment is in the crop. How much money have you've got invested in there? What is your current expected yield on a field-to-field basis? I'm sure there's going to be some variability. There are a few counties that did get dry, so I'm sure we will have some that aren't going to get the yields that they thought even a month ago. And then this is a big one. I really do think that we have a tremendous amount or a higher percentage than normal of 2020 crop that is currently unpriced, just because we really haven't had those in-season opportunities. So understanding how much of that you can end up storing on your farm or on off-farm storage will let you know how much you need to price between now and harvest, right? There will be some people that will be able to store the majority of their crop, but if you do have to trigger those sales, you maybe want to be a little bit more aggressive with this rally from the current derecho in case, you know, we do see a retreat, particularly in corn prices, if you don't have that ability to store on the farm. And then what is your price expectation? You know, when you look at where prices are right now, it is tough to make a real strong bullish argument. You know, trade is the one wild card that I think is out there. But if you're expecting corn to get back above $4 on the futures market, I think that might not be a realistic expectation given where we're at from a supply and demand standpoint, and then also the uncertainty that's been created because of the COVID-19 pandemic. So again, when we're working some of these numbers, that combination of yield and price minus production costs, profit is that goal, not the price. Sometimes we get a little hung up on, okay, well, I need this price. Well, if your yield is 10% or 20% higher than what you were anticipating, you know, maybe you don't need that high of a price to end up covering the production costs. So again, the only way to do that is to run the numbers on an individual basis.